This week, the RBA increased its cash rate by 50 basis points, increasing the mortgage repayments of homeowners with a loan of $500,000 by $140 a month. But economists are calling for RBA Governor Philip Lowe and the board to be sacked, claiming they have misled Australians and have actually contributed to the collapse of the economy and the housing market with monetary strategies that have put Australia and Australians in a parlous position where economic disaster now looms. Joining us to discuss this very issue is the Informer's housing and property expert and managing director of Olive Tree Finance, Daniela Greening. Welcome, Daniela.
Well, good afternoon, Michael.
Now, has Philip Lowe and the RBA contributed to the position we're now in, do you think?
I absolutely think they have. They indicatively said to the market that cash rates won't be going up until 2024. And a lot of home buyers and investors banked on the rates staying low until at least the end of 2024. I suppose what they couldn't foresee was a world war basically in Europe, which nobody could foresee at the time. But hence, the fact that they've been so forward in saying rates weren't going to go up has impacted, absolutely.
The call for them to be sacked, would that create more instability and more angst in the market, or should they just admit that they were wrong and stay on?
I think sacking them at the moment is almost impossible in the current market, and no government wants to be seen to be doing that and laying blame otherwise. But I think for the most part, if they stay where they are at the moment and look forward and try to make as many positive and confident decisions pushing forward, I think is the best way to go personally.
Is there anything that Albo and the Treasurer can do? Because it seems that the market, business and industry have lost confidence in Philip Lowe and the RBA board, and surely that can't be good for us.
Absolutely, I agree. The only thing that Jim Chalmers can do is what he's doing at the moment, which is running the inquiry into the RBA and the current policy settings. And also they're trying to find a way to, I suppose, impact monetary settings from a government perspective. But as we've discussed previously, in the current economic climate, it's really hard to do because they can't be seen to be injecting too much money into the economy because of inflationary pressure. And obviously in the other side is if they are impacting housing market, then the prices are going to go up. So there's this sort of balancing act at the moment that they're all trying to keep everything in its spot and obviously not impact the inflationary pressure too much, which in turn will increase interest rates yet again.
All those years in opposition wishing to be in government, it's nearly like a poison chalice at the moment. Now,
it's the hardest time to be the government in this current economy.
Now, as the managing director of Olive Tree Finance, what advice are you giving your clients, Danielle?
At the moment, I think we've historically seen that new to market or new to lender clients are getting the best rates. So if you look at, as you said, your $500,000 loan, this month alone, there's a $140 increase. If you look at it since the rate rises started in May, we're talking about a $472 increase over the loan. If you look at something that's $1 million, this month alone, it's another $281. And since May, that's $944. So there's two things people can do. Firstly, go back to your bank or your broker and ask them to have a rate review on your existing loan balance. If you don't get any satisfaction, look at refinancing. Talk to a broker about refinancing the loan, because obviously going to a new bank, you're going to get that wonderful introductory rate, which is generally lower than the current comparison rate in the market, which will reduce your overall repayments.
Now, I read recently that as much as 33% of mortgage owners in Australia have changed their lender in the last 12 months. 2/3 that don't do it, is that just, are they happy where they are, or they just haven't looked into it?
I think it's a bit of boat A and boat B. I think a lot of people find it really hard to refinance. They think that's too hard, get all the paperwork sorted. The easiest way to do it is to speak to a broker. Get your license, get your driver's license, your pay slips and your mortgage statements all together, and the broker will do all the hard work for you. They will find you the best lender with the best rate and give you the best offering. So it's not that hard, but I think you're right. I think a lot of people just don't know how to do it, how to go about it, or a bit sort of unsure about changing banks and what the implication for them is.
as a mortgage owner, is extending the term of the loan one way to lower the cost of your weekly and monthly repayments? Is that worth doing, or is that something you'd advise against, Danielle?
Well, for most people, extending the loan life is not necessarily the right thing to do. It can help with overall cash flow, particularly with investment lending, because obviously taking the loan back out over 30 years means you're overall reducing the monthly repayments. But the other thing I say to people is, if you do refinance, have a look at what your current loan term is. If you reflect it and make the extra repayments as you were previously, you will be in front. You'll also have that extra money sitting in offset. So for a rainy day, if something happens and you need some extra cash, you've got it there to redraw.
Great. All right, Danielle Agrini, Managing Director of Olive Tree Finance. Thanks so much for your time.
Thanks, Michael.